Nvidia's stock has gone from 455 to 108.10 in the last 5 years. That's 23.8x. Nvidia designs powerful GPUs and AI platforms that drive everything from high-end gaming to data centers, artificial intelligence, and autonomous systems. They're a leader in cutting-edge tech, enabling breakthroughs in industries like AI, healthcare, and robotics. But with a market cap of almost $2.6 trillion, will the stock continue to skyrocket, or is the bubble about to burst? Let's dive right in. Okay, 5 points that this video covers. Point number 1, company background, business model. The company is a pioneer in graphics processing units, or GPUs, for gaming and professional markets. They're leading in AI data centers, autonomous driving, and high-performance computing. Part 2, Nvidia's investments. The company recently filed its disclosure of 5 investments it has in public companies, and I can't wait to reveal them to you. Part 3, company update. Nvidia reported its 2Q results a couple of weeks ago. I have reviewed the results and I can't wait to share my insights with you. 4, the opportunity, positives and negatives. The stock is one of the best performers, but is it ahead of itself or does it have room to run? 5, valuation. On Wall Street, we built 3-statement financial models culminating in a discounted cash flow, or DCF, valuation. I have built a 3-statement model with a DCF for Nvidia and I can't wait to give you all the details. So let's dive right in. If you're enjoying this, please smash that like button. Okay, part 1, company background / business model. Here's the story. In the early 90s, Jensen Huang was passionate about video games and believed the world needed better graphics processors. So soon after that, in 1993, he founded the company with Chris Malachowski and Curtis Preem, and they started Nvidia with just $40,000 in seed money from Huang's apartment. They had no idea how much of an impact their invention would make on industries far beyond gaming. Today, Nvidia's GPUs are powering some of the most powerful AI applications in the world. The company is headquartered in Santa Clara, California, and their mission is to solve the world's most challenging problems by advancing computing technology, particularly through innovations in graphics processing, artificial intelligence, and high-performance computing. Their presence is significant in gaming, AI, cloud computing, and the automotive industries. Now, in terms of the business model, if we go back to 2016, Google stunned the tech world by revealing that Nvidia's GPUs were essential in powering the AI behind its revolutionary AlphaGo program. AlphaGo's ability to defeat a human Go champion showcased the real-world potential of AI, and this success put Nvidia's data center business on the map. Today, these GPUs remain critical in AI and machine learning. Well, how do they make money? 87% of revenues are from data center. This provides AI, deep learning, and high-performance computing solution with its A100 and H100 GPUs. Major customers include cloud providers, AI startups, and large enterprises. 10% of revenues come from gaming. They're a leading provider of GPUs for gaming consoles and personal computers with products like GeForce. 2% of revenues are professional visualization. This offers Quadro GPUs for software for professional applications such as architecture, engineering, and design. And then 1% of revenues, automotive, OEM, and other, they're developing autonomous driving systems and AI-based solutions for automotive companies. They're also licensing and selling their chip designs to original equipment manufacturers. All right, part 2, Nvidia's investments. I'm super pumped about this. Nvidia, like many Mag 7 companies, has a venture capital arm called NVentures, which has upwards of 150 different investments. Now, in addition, Nvidia has 5 investments in public companies, which they're required to disclose, and I've broken them down for us. Now, the summary of why Nvidia is investing. Nvidia's investments in these companies align with its strategic goals of dominating sectors where AI, computing, and autonomy are poised to drive future growth. These investments touch upon industries such as healthcare, robotics, semiconductor design, and AI-driven technologies, all of which are areas where Nvidia's GPUs, AI platforms, and data center solutions can provide significant value. All right, investment 1, ARMS Holdings PLC. ARM is a leading semiconductor and software design company, particularly known for its processor designs used in mobile devices, servers, and a variety of consumer electronics. Now, why is Nvidia investing? Nvidia previously attempted to acquire ARM for $40 billion, but the deal was blocked due to regulatory concerns. However, investing in ARM shows Nvidia's continued interest in ARM's processor designs, which complement Nvidia's own GPU technology, especially for applications in AI, IoT, and edge computing. Number 2, NanoX Imaging Ltd. NanoX is a medical technology company that focuses on developing innovative, cost-effective imaging solutions using novel digital X-ray technology. So why is Nvidia investing? Nvidia's investments in healthcare have been growing, and its AI and GPU technologies are increasingly applied to medical imaging and diagnostics. Investing in NanoX could align with Nvidia's vision to transform healthcare through AI-powered imaging, where faster and more accurate diagnostics are critical. Number three, Recursion Pharmaceuticals. They are a biotechnology company that leverages AI, machine learning, and automation to discover new drugs and treatments faster by analyzing massive data sets of biological data. So, why is NVIDIA investing? NVIDIA's GPUs are vital in accelerating AI workloads, and Recursion's focus on AI drug discovery is a natural fit for NVIDIA's AI ambitions in healthcare. NVIDIA likely sees synergy in partnering with companies that push the boundaries of AI for faster, more efficient drug discovery, especially given the high computational needs in this field. Number four, Serve Robotics. They're a company focused on creating autonomous sidewalk delivery robots for local deliveries. The robots are designed to improve efficiency and reduce emissions in last mile logistics. So, why is NVIDIA investing? Serve Robotics operates in the realm of autonomous technology, an area where NVIDIA's AI and GPU products have significant applications. NVIDIA has been pushing further into autonomous driving and robotics, and Serve Robotics represents an opportunity to bring NVIDIA's autonomous tech to a growing sector focused on robotics for urban deliveries. Number five, SoundHound AI. SoundHound AI specializes in voice recognition and natural language processing technologies. Their focus is on enabling AI-powered voice interfaces in various industries like automotive, hospitality, and IoT devices. So why is NVIDIA investing? NVIDIA has a strong interest in AI-driven voice and natural language processing applications. As industries adopt more voice-activated systems, NVIDIA's GPUs can power the underlying AI for real-time processing. SoundHound AI's technology complements NVIDIA's AI ambitions, particularly in making AI more accessible through natural user interfaces. So what's the takeaway? NVIDIA is not only being entrepreneurial internally, but externally as well. And this proactive approach to investing and supporting these AI-focused companies should continue to help keep NVIDIA ahead of the innovation curve. All right, part three, company update, the 2Q financial results. So NVIDIA recently announced its financial results for the second quarter of fiscal 2025, and they were impressive. CEO Jensen Huang highlighted the company's leadership in AI and announced that samples of their next-generation AI chip, Blackwell, are already shipping, indicating that NVIDIA is preparing for continued dominance in the AI chip market. Revenue. NVIDIA reported record revenue of $30 billion, a 122% increase from the same quarter last year and a 15% increase from Q1. This growth was primarily driven by booming demand for AI technologies. Data center revenue, the largest contributor, was $26.3 billion, a 154% increase year over year. This was fueled by the rising demand for AI, accelerated computing, and generative AI tools across global data centers. Gaming revenue also grew, reaching $2.9 billion, a 16% year-over-year increase. NVIDIA continues to be a leader in gaming GPUs and AI-powered gaming technologies, and they're enhancing their product portfolio. Automotive revenue saw strong growth, increasing 37% year over year to $346 million, reflecting NVIDIA's push into autonomous driving technologies. Now, in addition to these stellar financial results, NVIDIA's gross margin improved to 75%, up from 70% a year ago, showcasing its ability to command high prices and margins in AI chips. The company also returned $15.4 billion to shareholders via share buybacks and dividends, and approved a massive $50 billion share repurchase authorization. Now, they also made several key announcements. Here's a quick summary of each. AI factories. They unveiled systems powered by Blackwell architecture for building AI factories and data centers. NVIDIA Spectrum X Ethernet. So this is widely adopted by cloud and AI service providers, with new products launching annually. NIM inference microservices are now available, enabling efficient generative AI deployments across multiple industries. NVIDIA ACE microservices launched to create generative AI, avatars, and digital humans. Physical AI revolution. So they're driving industrial automation and robotics with NVIDIA Isaac and Omniverse platforms. And lastly, generative AI models. They released for OpenUSD to expand 3D design and simulation workflows across industries. So what's the takeaway? NVIDIA's financial results continue to impress. They're firing on all cylinders, and they continue to innovate. Part four, opportunity, positives, and negatives. I like the bad news first. Let's get it out of the way. Now, first, a little story. In 2021, NVIDIA found itself in the middle of the US-China trade war when the US government restricted the sale of its most advanced AI chips to China. This geopolitical move sent shockwaves through the company's stock and raised concerns about how international conflicts could impact its business in the future. And this directly relates to one of our negative points, geopolitical risks. As a key player in semiconductors, the company faces exposure to US China trade tensions and export restrictions, particularly concerning AI chips. Supply chain risks. So, dependency on third party manufacturing like Taiwan Semiconductor means supply disruptions could impact NVIDIA's ability to meet demand. Cyclicality in gaming and consumer electronics. Now, while gaming revenue has grown, it remains exposed to consumer spending cycles, which can fluctuate. Competition. So, rivalry from competitors like AMD and Intel, as well as new entrants in AI chips like Google's TPUs and Amazon's Gravitron, could pressure market share. Let's face it, guys, the Mag 7 are making their own chips in house, which is a major development not to be overlooked. Valuation concerns. The stock trades at a high price to earnings multiple, which could make it vulnerable to corrections if growth expectations are not met. In addition, at 2.6 trillion of market cap, Nvidia is subject to the law of large numbers. With US GDP north of 28 trillion, there is a ceiling on how big Nvidia can grow. All right, so before we cover the positives, a little story. In 2020, Nvidia played a pivotal role during COVID-19 pandemic by offering its GPUs to universities and research labs worldwide to accelerate AI-powered research. These tools help scientists understand the virus and search for treatments much faster than traditional methods. This highlighted Nvidia's crucial position in both technology and society. And it's pretty crazy stuff because Nvidia's technology can enable drug testing on humans without actually involving humans. So it can actually simulate a human being and various organs through the testing process, which is absolutely incredible. All right, so more positives here. High profit margins. The 75% gross margin shows pricing power and operational efficiency. Strong financial growth. Triple-digit revenue growth year over year driven by AI and data center demand. Innovative product pipeline. So they're constantly evolving their GPU technology and development of AI software stacks. Dominance in data centers. So NVIDIA's GPUs power the largest data centers globally, giving it a strong foothold in the growing AI and cloud markets. AI leadership. NVIDIA is at the forefront of the AI revolution with GPUs that are integral to AI model training and inference. And lastly, tailwinds from the AI boom. Increasing demand for AI, machine learning, and autonomous systems is driving significant growth in key markets. All right, part 5, the moment we've all been waiting for, the valuation. So a few things to note. NVIDIA is not the type of stock that we can reasonably build a DCF model for. Building a DCF model is going to result in high or unrealistic expectations and numbers, and that's because they have what's called parabolic growth. You can't come up with a single number for the top line growth rate that's going to work because they're going to continue to grow very rapidly, and the growth is increasing at a decreasing rate. That's going to result in significant issues when trying to do a single point estimate for top line revenue growth. Now, using Wall Street consensus, we get significantly lower numbers and lower valuation. But we do need to understand that Wall Street has Nvidia around a fair value with a high of about $200 per share, which is an 85% upside, and a low of $90 per share, which is 17% downside. So there's a very wide range here. So what we did was we ended up taking the 3-year average, the 5-year average, and Wall Street consensus numbers and built a model for each. So what I'm going to do is I'm going to walk us through the 5-year average numbers, that model, and then I'm going to wrap it up with all 3 models in the end. Okay, part 1, the balance sheet. The company has tons of cash, $26 billion at the end of 2023 and $34.8 billion at the end of 2Q. That's 33.8% growth in 6 months. Now, despite massive growth, they have very low leverage, only 0.3% of total capital. And what it shows is that they're reinvesting capital, which is a really great sign. And that reinvested capital is what's driving their growth. They're not driving it from increasing equity or increasing debt. Also, retained earnings has increased 2.4x over the last 5 years. Now, this is driven by net income, which we're going to see next in the income statement. So what's the takeaway? The company is very conservatively financed with a solid balance sheet and a AA- credit rating. Let's hop in the model. All right, so the balance sheet, we have a 3.5x 5-year increase in cash and short-term investments, which is incredible. If we add these together, we see it's about $26 billion at the end of 2023. We can see debt is actually coming down. It came down even further in 2Q. Retained earnings is increasing at a nice clip, 2.4x. The balance sheet is super solid. All right, next we have the income statement. Revenue has more than doubled in 2023, but cost did not increase at the same rate. So there's been a 5.2x increase in revenues over 5 years and only a 3.5x increase in operating expenditures, which shows incredible operating efficiency. We're also going to see this next in the cash flow statement. The company is net interest income due to the invested cash generating more than the debt costs. They also have incredible deferred tax assets and a low tax rate of only 12 to 15%. So, what's the takeaway? From 2019 to 2023, revenues have grown 5.6x, while net income has grown 10.6x. That shows positive operating leverage, which is an awesome result for the company. Don't forget, revenue's what you make, net income's what you keep. Let's hop in the model. All right, the income statement, as we mentioned, we have a 5.2x increase in 5-year revenue top line, which is just tremendous. Also, the company is net interest income, which means interest income from the cash that they've invested is greater than the interest expense from the debt that they have. Also, taxes, they've actually been able to keep a lid on it. They've been utilizing their deferred tax assets to shield their tax exposure. And then last but not least, the company is growing at a tremendous rate, but their revenues are outpacing the growth in their operating expenses, which is tremendous. All right, next we have the cash flow statement. So they've seen a 7.5x increase in operating cash flow from 2018 to 2023, driven primarily by net income. There's been a $19.6 billion amount of share repurchases in 22 and 23, which is not a good idea now with high current prices, but they authorized another $50 billion. So this is something to keep an eye on. You don't want to overpay when you do share repurchases. The issue, though, is the company is generating so much cash, they have very few places to put it. Now, there's been a massive increase in free cash flow, 8.6x over the last 5 years. So what's the takeaway? Cash will 44x. Let me say that again. 44x by 2028 if the 5-year average trend continues. So what I anticipate is a little bit more capex, possibly acquisitions, so that they can have more efficient means to redeploy this cash. Let's hop in the model. All right, so as we mentioned, 8.6x increase, 5 years of free cash flow, absolutely incredible. Remember, free cash flow, we're saying operating cash flow less capex. We see the operating cash flow is absolutely ripped, again, primarily driven by net income right here. We see that even though the company has grown tremendously, CapEx is really not as high as one would expect. Share repurchases right here of 19.6 billion. Just keep an eye on that because that is going to increase substantially in the future. And then last but not least, we see a 44x increase in cash over the next 5 years. Absolutely incredible. All right, next we have DCF assumptions. So remember, we're using the 5-year average numbers. So those are going to be the drivers for our DCF. But a few other things to note here. The company has a very high beta, which is going to result in a high WACC. Beta is 1.75. But the company also has very low leverage and a AA minus credit rating. The company is net cash by $26.3 billion. That means cash is greater than debt. So what is the takeaway? Conservative assumptions equal conservative results. Let's hop in the model. All right, DCF assumptions, we have the 5-year risk-free rate. Again, the beta 1.75, fairly high. Market risk premium, we get a cost of equity of 10.52. Remember, they have a AA minus credit rating, so they have a super, super low cost of debt. But then again, they really don't have much debt. Very low leverage, way less than 1%. We come down to here, cash and cash equivalents. We see that they have a massive amount of cash as well as marketable securities. And one last thing to mention here. So the terminal multiple. So we took all of the comps and we got an average of 25.9x. And you see that the comps have a massive range from 10 to 52. Now, NVIDIA's current LTM EBITDA multiple is 42.1 times. Now, what I have here in the note is because NVIDIA has grown so rapidly, it's about to level off. The recent LTM EBITDA multiples are very large, and they're way too large to use, so we can't use an average of the most recent LTM EBITDA multiples. Now, the likelihood is we're going to see a reversion to the mean over the long term. Hence, I chose a 26 times terminal EBITDA multiple to be conservative. All right, so remember, in this model, we have a 3-year average model, a 5-year average model, and a Wall Street consensus model. So the 3-year comes out to be the highest, which makes sense because it's parabolic growth. 5-year ends up being the lowest, and Wall Street consensus is slightly above the 5-year. Remember, we can't do a traditional DCF because growth is increasing at a decreasing rate. It's not linear. We have massive uncertainty, even with Wall Street coming down. So who knows when it's going to come down and how much it's going to come down. So the takeaway is that Wall Street consensus is a little bit above where the current stock is, but ultimately what we're going to see is a pretty wide gap if we look at the 3-year average versus 5-year and Wall Street consensus. Let's hop in the model. All right, everybody, DCF time. We start out with EBITDA, DNA, strip it out, get EBIT, strip out the cash taxes, we get EBIT. We add back DNA. We then have changes in operating working capital, capital expenditures. We get free cash flow to the firm. Remember our terminal value, 26 times terminal EBITDA. We get our cash flows to discount. We multiply them by the discount factor. We get the present value of free cash flow. That gives us our total enterprise value. We strip out debt. We add cash. We strip out non-controlling interest. We add associate investments. We get an intrinsic equity value of $2.7 trillion divided by the current shares outstanding. We get an implied share price of 110. The current share price is about 108. So we have a slight discount of 1.8, but it's a hold. It's not at enough of a discount for us to have what's called a screaming buy. All right, so I wanted to lay out for you revenue, EBITDA, and net income to show you the massive difference if we look at 3-year average, 5-year average, and Wall Street consensus. So this is the current Wall Street consensus numbers, top line revenue. From 2028 to 2023, we get a 3.9x increase. And what you can see, as I mentioned earlier, we have a massive increase going from 2023 to 2024. It basically doubles. And then it's increasing at a decreasing rate. We got 40%, about 18, 10, and 6. The problem is if you use the 3 and 5-year averages, you get lower in the upcoming year, and then you get significantly higher on the back end. So if we look at the back end, 2028, Wall Street has about 240, but then we get 413, basically 414 for the 5-year average and 690 for the 3-year average. So we have a massive, massive gap here. This is why we can't do a DCF in a traditional sense on revenue. All right, so similar results here when we look at EBITDA. What we end up getting is Wall Street consensus has a massive increase in EBITDA year over year. We see right here, it's going to be a 64 or 65% EBITDA margin. We get significantly lower margins in the other instances, but because we have such a massive increase in revenue growth over the long term using the 3 and 5-year average, we end up getting significantly higher EBITDA on the back end. You can see the difference in the 5-year average case is only 4.5x. That's very close to the Wall Street consensus, but the 3-year average numbers end up giving us a real bonkers number. We get almost double the EBITDA in the terminal year, which also remember, that's going to have a significant impact on the valuation because remember, we have the terminal EBITDA multiple at the end. So the higher the EBITDA is, the higher that terminal value is going to be. And last but not least, net income, same story here. We end up getting Wall Street about 124 billion in 2028. We get the 5-year average, which is a little bit closer to it. But again, we get a ridiculous number, almost double the Wall Street consensus in the 3-year average. This is why you have to be careful. Just doing a plug and chug traditional DCF isn't going to work for a company like Nvidia. All right, so looking at the 3 different results, we end up getting a buy rating with the 3-year average. Remember, that's a super high growth rate. With the 5-year average, we get a hold. With Wall Street consensus, we also get a hold. And we've got, these are the 3 following answers in terms of the intrinsic values. We get 199 per share using the 3-year average, which is just bonkers. We get 110 using the 5-year average. That's the model that we presented in this actual video. And then Wall Street comes out to about 114. So the punchline is this. We get a hold rating with the 5-year average as well as Wall Street, and we get a screaming buy rating using the 3-year average. But I just wanted to show you this so that you could see the 3-year average just doesn't even make sense when you look at the numbers and how they project out. You basically get double the results of reality in 5 years. Also to note, we used a weighted average cost of capital of 10.5, terminal EBITDA multiple of 26. All right, the wrap up. So Wall Street consensus estimates for our model gave us a value of 114 versus a 108 close. So it's about 5.5% undervalued. Now remember, Wall Street's range is 200 at the highest, which is 85% upside, an average of 150, which is 39% upside, and a low of 90, which is 17% downside. Now, you should seek the advice of an investment professional always. I don't know your financial situation, and my content's meant to educate and is not investment advice. Now, I do have a position in Nvidia, and if it pulled back to the low 90s, I'd be very interested in adding it to my position. Remember, Nvidia is a classic momentum stock. If you're interested in buying it, you might have to accept that you won't get it at a full 20% discount unless they miss earnings, and that might take some time to occur. Personally, my average price is $83.81, and I paid that when I estimated the fair value to be about 90, which was only a 7% discount. Now today the stock is 108.10, so my position is up 29%, but I would have no Nvidia if I chose to wait for a bigger discount, the typical 20%. Now, if you don't have any Nvidia, remember that almost 6% of the S&P 500 is Nvidia. So if you have an S&P 500 index fund or an ETF like Vanguard's VOO, you actually do have Nvidia. Nvidia is in a dominant position in GPUs and processors for AI data centers, but the Mag 7 is making their own chips in-house. So their dominance will persist, but it will be very interesting to see what the future holds. Now, if you like this and want to see another tech valuation, you could check out my Palantir video here or my Tesla video, which you can find here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.